Good evening, everyone, and a very warm welcome to all our distinguished participants. It gives me immense pleasure to welcome you to this important webinar on transfer pricing compliance framework in India, organized by the Committee on International Taxation of the ICAI. Friends, at the outset, I have the privilege of welcoming C.A. Chandrasekhar Chitleji, Vice Chairman of the Committee on International Taxation. Sri Chitleji is widely respected for his deep understanding of tax laws, his proactive leadership in the activities of the ICAI, and his consistent mentorship of young chartered accountants. We are truly honored, sir, to have you in our presence and continued guidance in shaping the professional discourse on international taxation.
Thank you.
Over to you.
Thank you. I wish good afternoon to all the participants, and especially thank to SK Singh sir for using charitable adjectives for me. I'm sure that everybody in council is devoting their time for the purpose of cause of the profession, and that continues. Sanjay Agarwal today has been to Portugal, where the conference for international tax is there. So maybe next webcast will bring in more inputs and the developments in international scene. From international, let us come to India. The domestic transfer pricing. Last time also we had understanding of transfer pricing. This is particularly, as I said, one topic which gives you passport for global practice, because the transfer pricing is not peculiar to India. It operates everywhere in the globe. And actually, India has borrowed it from the developed countries. They were first to ensure to protect their borders where income is being generated outside the country, and they are losing their share in tax. So that concept was brought in by these advanced developed countries. And now virtually every country is embracing this particular phenomena. Now, as far as transfer pricing is concerned, there may be three aspects. One is identifying the associate enterprise and the international transaction. That is one part. Secondly, after having identified, maybe before entering into transaction, most probably, benchmarking that transaction for the purpose of arm's length price. Because unless the price is arm's length, you can transact, but then uh, there will be some tax implication if the price is not at arm's length. If the country to which it is adversely affecting, maybe that country would like to collect its toll of flesh of a pound of flesh. But the third part and most important part is how you have addressed these first two parts, as to identifying associate enterprises and transactions. And then having identified these two things, what is the transaction price and how the enterprise has benchmarked the transaction price. Now, there are two types of tax audits, particularly in case of those corporates which are doing in business. One is the tax audit under section 44AB, and this 92C, the transfer pricing. I would say it is certification rather than audit. Because in case of tax audit, particularly in 44AB, an auditor is asked to identify what are the disallowable amounts. In case of, say, 43B, what payments are not made, what are allowances, earlier period disallowed, now you are paid. But in case of this transfer pricing, what the chartered accountant is expected to do is he has to list out all the transactions, that is his responsibility, all associate enterprises. But then as far as this benchmarking is concerned, it is left to the assessee to do the benchmarking, and chartered accountant is asked to the method through which this benchmarking has been done. Of course, that is as far as the government compliance is concerned. But then when it comes to assessments, hearings, and really to have a health check for the purpose of enterprise, I think he has to go a step ahead. and see whether that benchmarking is appropriate or inappropriate. And thereafter, the real inputs start. But at this stage only, one has to look at the benchmarking aspect, because if subsequently addition is made, there are various costs involved, not only the amount of shortfall from the arm's length price to transaction price. Maybe the associate enterprise will have to collect that money. If it is not collected till that time, there would be some interest outflow and several other consequences. So, while conducting this transfer pricing certification work, one has to be more vigilant. And wherever he has to flash red light, I think it would be a duty of the auditor, not in a legal sense, but maybe in a moral sense, to warn the client that, okay, these are the transactions where we believe that something needs to be done, or you suppliers with more inputs where the transactions can be benchmarked with appropriate pricing. So, friends, as chartered accountants are concerned, this is more important from the compliance perspective. Now, courtesy various high courts, 1 year month extension has been given to tax audit, and while doing so, it has stated that all audits are extended. Now, the speaker would enlighten us whether those all audits also include this transfer pricing, because whether it is audit or certification, that would make a difference. The circular says all audits. So maybe we are fortunate that we have learned chartered accountant. Fortunately, I would say he's in India, otherwise he's out of India for this transfer pricing and other work, Rishabh Agarwal. So we are very thankful to you, Rishabh, for agreeing to deliver a lecture. And I think this aspect also you may take care of, so that people should know whether they should conclude their job by October or by November. So with this, I welcome once again all the participants, viewers, for this webcast, and I'm sure that you will get value add till the end of the session. Thank you.
Thank you, Chitli Saab. Very nice introduction. And it's very interesting. I mean, if you look at the transfer pricing regulation, the audit by the tax departments come very late. It is the audit by the chartered accountant who starts from the day one. When you plan any transaction, in a business plans any transaction, and when Form 3CV is required to be submitted to the department. That is the point where the first level of audit happens. So it becomes very important for us, for the chartered accountant fraternity, to understand the compliance requirements, various nuances of transfer pricing. And it's a very interesting time where we are. In fact, the law was introduced in 2001, and it's going to be the Silver Jubilee celebration, I mean, in 2026.
And I think you were also part of development of law. So,
Sir, the good part is due to me, sir. So, friends, as we are approaching the 25th year or anniversary of transfer pricing, we can see how it has developed from the Bare Act to the landscape which is covering. It initially started as focusing on the anti-avoidance measures, and now it has matured into a very comprehensive compliance framework that mirrors global developments such as OECD's BEPS initiative, etc. Over the years, friends, the scope of transfer pricing in India has expanded very far. It goes beyond international transactions. It now covers specified domestic transactions, profit attribution to permanent establishments, secondary adjustments under Section 92 CE, and thin capitalization under Section 94B. This expansion reflects both the increasing complexity of global business operations as well as India's commitment to a fair and transparent tax system. The arm's length principle remains the cornerstone, ensuring that profits are aligned with the real value creation. This is very important so far as transfer pricing is concerned. You will appreciate that business has moved a lot from decentralized model of earlier decades to centralized IP structure and now digital platforms. But all along, transfer pricing has continued to play a key role in maintaining tax equity across borders. The compliance framework, as Chitlaji has rightly highlighted, is now more rigorous and is data driven than compared to any time earlier. The three-tier documentation, that's the local file, master file, and country by country report, requires consistency and accuracy across all levels. Now, when you combine this with the twin system which the tax department has introduced, which is computer assisted scrutiny selection system and a risk based assessment, the need for a robust transfer pricing documentation becomes very, very important. It is no longer a formality. It is a strategic pillar of the tax governance. And at the core of this framework is Form 3 CEB, which is the accountant's report under Section 92E. Digressing slightly, when we were debating about the transfer pricing regulations, we thought of having this Form 3 CB, which was not there in many countries. And one of the consideration was that let somebody apart from the business look at the transfer pricing setup to ensure that when it goes to the tax department, the business doesn't come across heavy additions. Its accuracy of Form 3B's accuracy defines the taxpayer's compliance credibility and as well as readiness for audit scrutiny. If we look at how the transfer pricing regulation has developed in India, in the recent years, block transfer pricing assessment scheme for multiple years has been introduced, which represents an innovative shift in dispute resolution. When you combine it, two important regulations, the Safe Harbor and the APA, then one appreciates the government's commitment to reduce uncertainty and litigation. However, in spite of this, there are certain areas where the dispute continues. Say, for example, deemed international transactions, benchmarking of low value add intra-group services, interest on intercompany receivable, payment of royalty, and profit attribution. These areas call for continued dialogue and practical clarity. The digital economy has added another angle. The non-resident enterprise with Indian operation are required to file Form 3CB even for head office branch transactions requiring compliance to Article 7 principles. Concepts of digital permanent establishment and significant economic transactions presence add complexity to the whole scenario. At the same time, secondary adjustments, intercompany financing, and valuation of marketing intangibles require continuous documentation and vigilance, given the global move towards transparency and automatic data exchange. Against this complex and evolving backdrop, today's session becomes especially meaningful. We are fortunate to have with us CM Mithilesh, who brings deep experience in analyzing intricate transfer pricing structure across diverse industries, and CA Rishabh Agrawal, who has wisdom to understand international taxation and transfer pricing regulations and expertise to implement and defend them. He will not only share his insights but also moderate today's session. Their combined practical and advisory experience ensures that our discussion today will be both technically rich and grounded in professional realities. With these thoughts, friends, and with great pleasure, I now hand over the session to Sri Rishabh Agrawal to take the proceedings forward. Thank you.
Thank you, SP sir, for wonderful context setting, and Vice Chairman sir for joining and giving us time and also this opportunity. Uh, I, along with Mitlesh over here, we are going to focus on today's topic on the transfer pricing compliance framework, where I think the need of the hour, as Chitle sir also mentioned, would be complete guidance on Form 3CEB, clause by clause guidance, so that would also be part. I think the context has been set. So I will, what I will do is I will quickly do a small warm up to grease everyone on the transfer pricing aspects. And then Mitlesh will take it forward on clause by clause analysis of Form 3CEB, where which transaction has to be reported, alongside what are the confusions and the open issues which almost every person who is filling Form 3CEB faces. And considering the timelines, I think Chitles or Mitlesh would also be answering on the timeline whether it has been extended for Form 3CB or not. So I think that will be duly covered in the deliberation. So with this, we have a lot of content. However, I will do a very quick warm up. SP sir has covered the complete history and also mentioned that it is the Silver Jubilee year. In April 2026, we'll be completing 25 years of transfer pricing in India. So that's that. But this is what is the most important aspect when we look about transfer pricing is the life cycle, or how we start and where we are right now. So you could see step number 5 over here being TP documentation and compliances. This is where we stand as on date in the month of October 2025. Whereas the steps 1 to 4, from structuring, policy setting to implementation in the systems and determining any adjustment, if at all required, has already been done. We talk about doing year-end compliances on local file, master file, CBCR, and also the transfer pricing audit, that is Form 3CEB. Once that is done, we go on to step 6, that comes later, on the litigation framework or any dispute resolution that has to be done. So today's, I think the deliberation again would focus on this step 5. So documentation and compliances, mostly compliances, and documentation would also be touched upon. With respect to the coverage, we all know, I think there are three main criteria or three main pillars to become a related party or associated persons. So that's holding, management, and control. So if either of the two are true, either of the three are true, you are called as a associated enterprise, and that's wherein the transfer pricing compliances or transfer pricing provisions kick in. And as part of the coverage, there are three things that are covered and very widely known. One is an international transaction. Second is a specified domestic transaction, and third, a deemed international transaction. So all these three are duly covered as part of the transfer pricing provisions. International transaction being the most focused one, where there is a transaction between two AEs, where one of it is a non-resident, and it covers the complete host of transactions, from transfer of tangible property, use of intangibles, transfer of intangibles, financing, so interest, corporate guarantees, any sort of services, so back office support, ITES, or any technical services that are being given, alongside any other business restructuring that will happen year on year, maybe internal or external restructuring. So all of these transactions are covered as part of international transactions. When we talk about specified domestic transactions, of course, uh, the basic premise or the basic idea is to cover only the non-tax neutral, or wherever there could be tax advantage, that kind of a transaction. So there are certain sections in the income tax laws in India wherein there are different tax rates that do not apply to all the taxpayers. So in such scenarios, uh, we will be calling it as a specified domestic transaction. However, still the same relationship of ownership, management, or control needs to exist to still be considered as a related party. And one more thing that SP sir mentioned was on deemed international transactions. These remain again one of the most litigated ones and one of the most hidden ones. Why do I say hidden? The idea over here is that yes, we tried to circumvent uh, the international transaction provisions under of Section 92B, and we transacted with a third party, and then we asked the related party to have a pre-arrangement or have some sort of arrangement with the third parties. So I sell goods to a third party, and then my related party will buy it from the third party itself, and they have pre-agreed terms or conditions, so they have some pre-agreed arrangement. So why these are most hidden? Because these are not apparent from any of the paperwork that we do, be it financial statements, be it maybe management interviews, so be it agreements. So these types of transactions are not apparent from the things that are there on record. So this becomes a very big checkpoint for us while we are doing Form 3CB, because there's a specific clause which talks about the reporting of deemed international transactions. So we need to make sure that how, as professionals, we are covered if at all we are unable to, report any deemed international transactions that are there within the system. So talking about reporting and compliances, there are a couple of things that every SSC needs to do, and then there are certain things that are based on thresholds and applicabilities, so that bigger entities or MNEs come into the net, and the smaller taxpayers or uh, I would say smaller entities who are having international transactions are not captured in the overall scheme of things. So as I mentioned earlier, Form 3CEB local file is already there. So Form 3CEB does not have any threshold, and is to be filed with by every SSC having international transaction with associated enterprises. And there is no threshold for filing. You have to report all your international and specified domestic transactions in Form 3CEB. The local file or the TP study or TP documentation under Section 92D is another, I would say, popular compliance, or I would say uh, more done compliance because of its lower threshold. So if your international transactions are exceeding 1 crore rupees, so it's the threshold on the value of international transactions, both the provision and receipt, both sides of the legs are to be covered here. And if your specified domestic transactions exceeds 20 crore, that's wherein you have to maintain the TP documentation as well. With respect to master file, there are two forms, 3CEAA and 3CEAB. 3CEAA again has two parts, Part A and Part B, with a bigger confusion being who has to file Part A, because it says every SSC having international transaction has to file Part A, though it's a one-page form, the Part A. Part B is a detailed master file for which there are thresholds of consolidated group revenue 500 crores and other uh, thresholds on the international transaction. But still, the debate remains that does every SSC has to file Form 3CEAA Part A? So to answer that, from the plain reading, yes, they have to file, though it's a very simple form, a single page form, and it has to be filed by the SSC. So unlike Form 3CEB, is where we as chartered accountants are filing the form certifying, or I would say showing the transactions of the taxpayer, versus Form 3CEAA master file Part A is to be filed by the SSC itself. Form 3CEAB comes into picture when there are more than one entities of a multinational group that are operating in India. And so that there is no duplication of compliance, you can give a notification that, okay, so and so entity on behalf of my group is going to file the master file, that's Form 3CEAA. So you may consider it as my compliance as well. With respect to penalties, we have given, and I think everyone knows that there is a 1 lakh rupees of penalty for not filing of Form 3CEB, and not maintaining documentation is 2% of the value of international or the specified domestic transaction. Uh, the idea to put penalties over here is that these penalties are very high. If you go and look to the other penalty provisions within the Act, comparatively, these penalties are very high as compared to other non-compliances. So I think this is something which we should be mindful of, and be proactive in being more compliant, at least on the transfer pricing front. Coming on to Form 3CEAD and Form 3CEAC, this forms part of country by country reporting. As I mentioned, that's the third tier of compliance. So after local file and master file, we have country by country reporting. So it has to be done again by very large organizations. So having group consolidated turnover of 6,400 crores, which I think would get refreshed in the coming years, because all of this is linked to the OECD's threshold of 750 million euros. So the conversion, the forex rate has gone very high. So I think this will be revised soon, the threshold. And something similar in Form 3CAC, like we had in Form 3CEAB, that if any of your entities outside India are filing the CBCR and India has an automatic exchange of information for CBCR with that country, you can tell India that please go and ask the relevant tax authorities for my CBCR. So and so country has filed my CBCR, or my parent entity or an alternate reporting entity has already filed my CBCR, and that's the reason I'm not filing the complete CBCR form. I'm giving a notification under CBCR that you can go and check with the relevant tax authority and you can ask them for the information. And any which ways, that part of information will automatically be shared through the automatic exchange of information that is there. So, considering that today's focus will again be on the first part of this presentation, as I mentioned, that is Form 3CEB, I will quickly move forward and not spend a lot of time uh, on the other aspects, right? What we are trying to do over here is address the main issues or main questions. And one of the main questions, or I would say things that are missed out, or the pitfall, is whether the non-resident entity itself needs also to file the 3CB. We know there are two parties as part of an international transaction. One of it needs to be a non-resident, only then it's an international transaction. So for the resident entity, we all know we need to file Form 3CB, but the confusion arises whether the non-resident entity also needs to file Form 3CB, whether uh, the non-resident entity has, I would say, an exemption or a leeway of not filing the tax return in India, whether still it needs to comply with TP and have to file Form 3CB. So the short answer to this is yes. The thumb rule is to check the taxability. If the income or the transaction is taxable in the hands of the non-resident in India, be it through the act, be it through the double tax avoidance arrangement, 3CEB has to be filed even for the non-resident, and that is something which a lot of people miss out on when they are filing Form 3CEB and consider only the resident entity for 3CEB filing, right? And something similar we have here for permanent establishments of foreign entities in India. The 2 points of perplexity or confusion over here is that A, whether do I need to do the compliance? And B, if yes, then what is reportable for me? How do I treat myself? Even though, it's a permanent establishment, it's not a legal entity, it may be an extension of a non-resident uh, enterprise or a non-resident person. The PE itself has to comply again with all the rules that are there. So Form 3CEB being part of it. Once you say I need to file Form 3CEB, there are two main questions again that arise. First, being on what profits to be attributed. And there has been a recent report by Niti Aayog last week that how to allocate profits to permanent establishments of non-residents. So yes, that is one challenge. And second challenge arises on what transactions to be reported in Form 3CEB of a permanent establishment of a non-resident person in India. So with respect to transactions, I would say as a rule of thumb, go by the same logics that you've been going for resident taxpayers. See if the PE is transacting with probably any other branch or any other PE of the same non-resident. If the PE is transacting with its head office, only thing is you need to differ or you need to create a divide between, of course, fundings, shareholder activities, support by the HO versus supply of services or remuneration for any commercial activity. With respect to due dates, I would say still remains the same form, same rules, same ground to play. So nothing changes, irrespective that it's a PE and not a separate legal entity of a non-resident in India. Right. So another, I would say, confusion or another issue that arises for permanent establishments is the method that has to be used for transfer pricing. Uh, Usually, P's become extension of the HO. Certain times they might have, you know, distinction in terms of their activities, but certain times they might not have distinction in terms of their activities that the permanent establishment is doing in India. So the method again becomes uh, the issue. Again, rule of thumb as of now, as on the date, what law stands. So we may go by using the FAR approach that we do for any other transaction. So go and see what functions, assets, and risks the Indian PE is performing, bearing, and owning. So once that is there, basis the FAR, we can allocate certain profits to the Indian permanent establishments, and that becomes the value of transaction, and that's what needs to be reported in terms of Form 3CB. Only thing that we need to make sure that we consistently apply it year on year, whatever methodology we have selected, we consistently apply it year on year. And if we are, of course, changing, we need to be mindful of maintaining proper documentation and proper reasons on why we are changing and what we are changing. Right. So I've put a small comparison of the definitions in different regulations that we have in India. However, from an income tax perspective, we need to consider what is there and is under Section 92A. uh, why we have put this comparison again? Because there are a lot of relationships which might not be apparent from the financial statements, from the agreements, wherein we need to specifically ask the taxpayers or our clients in order, uh, to be secured ourselves for correct reporting. So there are a lot of relationships which are not considered from a Companies Act or an IFRS standpoint, which are considered as related parties or associated enterprises as part of the income tax segment for reporting of Form 3C, right? So I'm not going into the detailed comparison, but the idea to put over here is that we need to be more vigilant. We need to ask the right questions, and we need to be explicit about certain things when we are looking at 92A2, which are deemed AEs. When we are looking at 92A2, and of course, clearly and explicitly ask from our clients that whether we have any sort of relationship as mentioned under Section 92A2 with any of our parties which we are having transactions with. So that is the reason we've put this comparison over here. Right. So now coming on to the main aspect of today's deliberation, Mitlesh, I give it to you to take us and the audience through Form 3CB clause by clause, and also share your experience on which transaction has to be reported in different clauses based on conflicts that you have experienced across your career, and what's the right way to do things. Should I continue to share the presentation, or you will share it?
I'll share this also.
Sure, please.
This is not coming to share, I think. You able to see the screen? Yeah. So, hi everyone. I think it was a very good context and the background and the fundamentals and the applicability, threshold limits and compliances and due dates and what happens if you don't file the 3C. I'll start the presentation with a question. What generally happens is that for the statutory auditors and also for the tax auditors and for compliance consultants, Form 3CEB generally is being taken as AS18 or a related party schedule replication. So that was the exact reason why we just showed the comparison of the related party definitions, wherein certain aspects of materiality, significant influence, and any kind of transactions which are not falling under the related party definition from an accounting perspective or are falling in accounting perspective, which may or may not fall in income tax. So the most important point or the most important first step checkpoint that I would say is always to get into the entire transactional flow and the business and the functional analysis of the transactions. So what we need to do is just not, get into the RPT schedule and, try and replicate from there, but we need to understand the transactions with whom it is being done, at what prices, what business model, what terms and conditions, and are there any other third-party transactions, and have that initial grip over the identification of the related party. Second, what kind of transactions are they doing? Whether everything is being recorded or not being recorded. So the point is identification of related party, transactions, whether domestic, international, or whether everything is being recorded in the books of accounts or not. These are the first three important checkpoints. The other important thing is whenever you classify the transaction under relevant clauses, there are certain, overlay or interplay, I would say, and there is a confusion whether the transaction has to be reported in clause number 10 or clause number 20 or, residuary clauses. There's a lot of confusion around that. And there are certain transactions which may or may not be reported by the assessee. Assessee might have a different opinion that it is a shareholder activity or it is not a international transaction which is affecting my P&L. So these interpretations, classifications, reporting of the transaction are the second checkpoints. Now, wherever you're having AS 18 or IFRS or Ind AS and the related party schedules are coming up, and then the ownership management control capital, direct, indirect, 26%, all these elements from an income tax perspective are coming up. There is always a reconciliation as a first checkpoint that the income tax authorities and the transfer pricing officers also ask for. So this particular reconciliation, along with your, true and correct opinion, and also for the purpose of identifying the transactional values, gross versus net, recording of the transaction, accounting methodologies, revenue recognition aspects, and the true value of the transaction as per the intercompany agreement or the global policy also needs to be reconciled well, and a notes to Form 3CB has to be prepared. So normally, in a general sense, Form 3CB is just filed, by taking the numbers from AS 18. But this background and the understanding on the transactions, business, group level profile, functional analysis terms, and the specifics of the transaction in classification are the key elements. Now, getting into the specifics of the details of each and every transaction, there is a huge list of the supporting documentation that I will present at the end, maybe at the end of the session. So for you to analyze any transaction, the agreement, policy, the invoices, terms and conditions, and the actual delivery and the collection periods are also important. It's an end-to-end supply chain in terms of the understanding and gathering of the data. Yes, we rely on the work of the statutory auditor for the purpose of accounting and financial statements and all. But the point is, we have a separate guidance note issued by ICAI on the positions applied or reliance being placed and how the amendments are to be interpreted and how the disclosure has to be done. And there is a specific column or a specific note point, which is called as the notes to Form 3CB space, which is given. And you are not supposed to file any kind of special characters anywhere in the Form 3CB, but you will have this space for giving your own identifications and qualifications. So this is most important, as most of them do not know that notes to Form 3CB can also be filled in. So I'll show you the clause number 9 when it comes. But why am I highlighting and spending time here on this slide is there are very important checkpoints. Filing of the form or filling in the form and writing the same numbers as per books and as per ALP does not actually serve the purpose. So when it actually gets to an assessment, the transactions will be grilled into such a way that the reporting chart accountants or the reporting people who are signing this Form 3CB have also been asked to showcase what exactly have they audited or what exactly have they reviewed while giving this Form 3CB. Now, from the other angles perspective, there are 2-3 elements on the filing aspects where backdated filings, or even for the past assessment years, you can file now, or you can revise, or during the course of Form 3C, during the course of transfer pricing assessments, also Form 3CB can be updated. I'll show you that slide. This is the only form maybe, or other than Form 56F and 10CBs, the forms are getting filed even as on date for AY 1415. So there is no cutoff time, or there is no blockage of the deadline. One important thing, and wherever there is non-disclosure, and if the file is picked up for a TP assessment, then if assessee is filing it voluntarily after picking up, their first level transfer pricing authorities may not accept it, but certainly if the voluntary disclosure is there and the transactions are having good volumes and good arm's length, then they are being let on for the penalty purposes as well. So your entire checkpoints and remarks, notes, and classification, reconciliation, and getting into the specifics of the transactions are very important for Form 3CB. Now let's get into the 25 clauses. I'll be quick, but specific to certain clauses where the mistakes are regularly repeated, and I'll make sure that you are having that in the mind whenever you're filing the Form 3CB next time. So Part A, Part B, and Part C. There are 3 parts to this, and specifically 1 to 9, 10 to 20, and 11 to 21 to 25 are the clauses that are there for this Form 3CB filing. So Part A, are the factual details or the basic details of the assessee in terms of asking their, KYC or the name, address, PAN, and the assessment year for which it is filing, what is your business, and what is the aggregate value of international transactions and aggregate value of SDT. For SDT specifically, for specified domestic transactions, since the threshold limit is 20 crores, it becomes all the more important for you to understand that intra-group or intergroup transactions within India, but having a differential tax regime in terms of tax exemption and tax payment, the aggregate value among these tax exempted entities and tax paying entities should be crossing 20 crores. Then only the Form 3CB for SDT is required to be reported. For international transactions, even if it is 1 rupee international transaction, I think it will be revised very soon. But specifically, if you ask me, there is a real intent in not amending this particular international transaction value as such, because even if it is 1 rupee related party transaction abroad, cross border, the reporting compliance is coming into picture. So now from international transactions perspective, let's go to Part B. There is tangible, intangible, traded, and there are specific aspects of loan services, business restructuring, mutual agreements, and deemed international transactions, and residual clause. So if you see the entire definition of 92A, or the specifics of the international transaction definition, clause by clause, have been covered in this 10 to 11 clauses. So what generally happens is, for each and every type of transaction, there's a specific clause. There are specific details that are required to be filled in, and you have to comment whether your transaction or the deal that you are doing with the related party is at arm's length or not, as compared to your book value of as per your books of accounts. And there is a notes or observation or a remarks column at the end of each clause for each line item, where you can mention any specific remarks that you want to disclose or want to make sure that while filing the Form 3CB, you want to maintain the disclosure of the remarks or the observations. There's a 2000 limit of word, limitation for those remarks, but special characters are not allowed. Now, Part C, as I told you, 20 crores as the aggregate value, same specific first 3 clauses where the details of the associated enterprises are taken into picture. So even here in the first Part B, they have asked for the details of the associated enterprise, and from here it starts on the tangible and intangible kind of transactions. But from 21 onwards, the first 3 parts are the basics, where they're asking the nature of business and the relationship, and also on what exactly are their PAN address and the details, specifics as the first basic points, and then the real transactions, that is eligible business dealing with any other taxable entity, is required to file this Form 3CB. Now, if eligible entity is filing it, whether the other side is required to file from a tax paying entity standpoint, yes, both of them are required to file this, and they have to go ahead and file this particular thing on dual basis, because on one side, the extraordinary profit can be pulled in. The basic objective of this entire SDT is still being continued, is the fact that there is a 2016 amendment which has happened, and then they have stopped the reporting of 48 2B transactions and the domestic transactions as such. But wherever there is a chance of eligible entities and tax paying entities transferring their costs and profits and making it as an arrangement to make sure that there are extraordinary profits being pulled on the other side, wherever eligible business or exemptions are there is a checkpoint that is required to be maintained for the assessing offices and transfer pricing offices. That is the exact reason I think still this particular specified domestic transactions has been kept, and they have kept a good decent threshold of 20 crores or more. Now, what happens if it is less than 20 crores is the tax authority can, the assessing officer can generally get into this 80I 8 and 10A clauses in his corporate tax assessments, but it cannot be referred or it cannot be mandated for a specified domestic transaction report or an assessment. Now, in most of the situations, the combination is eligible and non-eligible. And the specifics of the last two clauses is the fact that there is 115BA kind of scenarios where manufacturing or new setup entities with 15% or 17.16% as the tax rate versus 25 or 30%, there is a tax differential that they can play around with. Movement of business for a willful arrangement and making sure that extraordinary profits are parked in a lower tax entity are also being tracked for this particular specific purposes. They want the objective not to be defeated, and hence they've kept this as a checkpoint. Last clause, as always, is a residuary clause where you can report reimbursement transactions, common costs, or any kind of cost sharing specific details with the SDT inter-unit or intra-unit transactions. So in brief, I have covered the overview. Now let's go into the specifics of each and every clause. So we'll try to cover the entire 25 clauses in the next 15 odd minutes or 20 odd minutes. So there will be repetition. So I'll avoid the repetition. I'll only focus on the core aspect of each clause and the specific checkpoints and clarifications and any kind of frequently asked questions on the specific clauses. So as I told you, the first 9 clauses are the specific basic details. But if you see here, there is a specific column that is provided for the observations and qualifications. If it is mentioned here, the most frequently asked question is, if I mention anything here, it may not be a qualification, but even if it is an observation, and even if it is a management I've relied on a management representation letter and I've certified this based on the data that is provided to me. Even if you write that, the understanding generally has been that this particular field has been a risk parameter. So any disclosure on this observation is generally, a frequency of getting picked up is what the experience has been trying to tell us on from the transfer pricing assessment standpoint. So this is one gray area. So what generally people started doing, even from Big Four or any of the Tier 1 firms, is they've started maintaining the notes to Form 3CB. All their comments, reconciliations and specifics on Reliance or any other auditor or valuation reports or cost auditor reports or specific details of customs valuation report. So all these aspects as annexures, what they're relying upon, they've been doing up notes to Form 3CB specifically. So wherever international transactions, there is 1 rupee. Even if it is 1 rupee, you have to do it. And specified domestic transactions, 20 crores. Now, there is one important area, other specifications where the observations and qualifications are being done. And if there is a non-recorded transaction, and if it is, if you're rendering the service to an entity globally, and you're not actually billing that particular component of service, if it is not recorded in the books of accounts, how do you, treat that then? So few auditors started writing that, this has not been reported. However, I'm reporting this as per books. It was 0. It should have been at least minimum of cost plus so-and-so. And this is what my opinion is. And it got immediately picked up for the scrutinies. So wherever there are scenarios of absence of comparables, or you're not satisfied with the arm's length nature, or not having specific concise records for the transactions, all these aspects, if it is disclosed, then there is high chance that the disclosure is being taken as a qualification rather. And that field itself is a very, very important field where you are writing something, and you have to be very, very careful about it. Now, the 9 aspects, I've covered this. I will go into the specifics of the details of the associated enterprise, where the checkpoint on the nature of relationship, the name of the associated enterprise, and the description of the business carried on with the associated enterprise is required to be reported. Ownership, management, control capital, 26%, direct, indirect, and you have associated enterprise specific definitions where threshold limits are crossing for any kind of loans or financing or dependency, mutual agreements, or wherever the aspect of associated enterprise definition is there, you have to select the nature of relationship. You have to write what exactly is the business that we are going to do. But if it is a representation letter saying that, even though we are not having any kind of ownership, management, control capital, and I'm a sole supplier, the relationship is independent. If they are writing and giving you that, what exactly is your view on that particular aspect? So I will tell you certain tweak points or specifics where the challenges have come in terms of specifying that yes, on paper we are not a related party, but I'm dealing 100% with a third party, and I'm having independent pricing structure. Nobody influences me, but the specific aspect of significant influence and mutual dependency of business makes you associated enterprise or not. And if the management is giving you a written representation saying that these are independently operating entities and there is no relationship, so you don't disclose, what exactly are you going to do? And are you going to write it as an observation? Are the critical aspects. If the dependency is 100% and if they cannot operate without the support of the other, and either or if the pricing influence is there or not, if the dependency of the business is there, then they fall under the significant influence aspect as per accounting standards also and as per the income tax. So please be very careful about those kind of peculiar circumstances. All the related parties, AS 18, whether irrespective of the materiality thresholds, significant influence thresholds, or the criteria of group company, associated enterprise, or any other aspects, your definition of income tax is important, and the clauses of the related party transactions is very important. So I'll quickly cover the entire clauses once in terms of what exactly is covered at each clause, and then run through this the specific challenges. 11 to 17 is there on the screen, and there is a lease or use of tangible property, transactions in intangible property, services, lending, guarantee, sale of securities, and mutual agreement. Now, all these aspects have had their own bit of litigation. I would say the transfer pricing in India has been 25 years old, and we're one of the largest transfer pricing disputed jurisdictions, that I would say. But the evolution that has happened in terms of the maturity from the department standpoint or from the officer's standpoint has grown immensely in the last 3 to 5 years. So what generally happens is the aspect of the definition, interpretation, and the hidden or underlying transactions are also being excavated, and they're asked to be reported. So tangible property, generally, you can see it, feel it, and have a specific aspect of, trading, manufacturing, supply, every bit of it. But what is the most important criteria is the pricing in terms of the specific breakdown of the price. And if you're using a cup, strict comparability. And if there's a valuation in any other, act or a specific law, like valuation or customs, or, in terms of your registered value reports for shares, whether these kind of elements are to be taken into consideration for cup or other method is one important area. So for tangible properties, there are specific aspects of quantities, units, and measurement criteria, and strict comparability if you're using cup, and specific profit, whether sales minus or a cost plus is applied in terms of the business criteria, business model criteria is very, very important. what I would try to tell you is, in most of the tangible properties, the unit level measurement has been digged into. And what is the model with which the tangible property has been shifted from one related party to the other? And the pricing model, whether they have internet transactions or not, would be the important checkpoints to be taken care of. And if you are writing, there are in your disclosure, if there are more than one related party with which you are doing this tangible property, you have to disclose for each and every related party specifically. And what details are to be disclosed, we'll see in the next slide. So the tangible property area, what were the transactions specifically that are required to be covered under clause level, and what challenges that you would be facing in terms of CUP or TNMM or comparison, business model, characterization are the very, very important key criteria for determining the arm's length nature of the tangible property transactions. Intangible property, it's one of the most litigated topics in the last 3 years, and there are specific definitions that go into this intangible property as per the Income Tax Act or as per transfer pricing regulation as such. But any kind of purchase, sale, transfer, lease, or use, you see this combination of purchase, sale, transfer, lease, or use, so it becomes the most complicated. So whatever you deal with comes into picture. But if you are created an intangible in terms of CWIP, and that is being funded by a parent entity in terms of hard to value intangibles, or in specifics of research may come true or may not be able to give you results, there are those kind of challenges that are coming in as India is evolving their own jurisdiction in terms of each and every entity becoming matured entity for the development of global intangibles and the rendering of services. So talking about services, the characterization, the nomenclature, and the people behind the services are the key. So if it is technical, managerial, consultancy, IT, recruitment, even the safe harbor rules or the specific determination by the tax authority tomorrow also would depend upon the description of service as a first prima facie step. So whatever you are giving as a description would later be evaluated and then got into the specifics of the cost elements in giving these kind of services, and the markup and profit will be compared with the open market scenarios. So whenever you are describing the service, not just from a withholding aspect perspective, but also from a transfer pricing perspective, clause 13 is very, very important. And there are certain cases which have changed, turnaround in just the matter of, calling it as a business support service versus software services as such. So in terms of calling it as a low-end service provider versus high-end service provider, the entire gamut of, bucketing the entity into a higher tax bracket, higher margin or lower margin will be determined by the tax authority. For loans, specifically, the borrower credit rating, in the currency in which it is being given, and the credit period terms, and the specific aspects of the cost to the lender are the key elements that are required to be checked for the loan benchmarking transaction and specific aspects of the financing element. But these transactions can also have a specific guideline based interest aspects and key limitations from FEMA or any other aspect of capping perspective is concerned. But what generally has happened is the receivables category or the payables category, generally, whether it has to be reported under this loan benchmarking, or whether it has to be reported under the specific tangible, intangible, and services, and the resultant outstanding receivables, payables are also required to be reported here, or it has to be reported at the other residuary clause, is a most frequently asked question. So other residuary clause is better, because it will be neutral and you will have a say at the department also that it is not a separate international transaction and you have benchmarked it together on a combined basis, and you are also having the specific separate line item disclosures as a residuary clause as a mandatory disclosure, but you're not clubbing it under any other area of benchmarking as such. So answer is other transactions for receivables and payable related queries. Now, from guarantees perspective, implicit guarantee and explicit guarantee, any kind of performance guarantee or financial guarantees, and specific aspects of not charging a guarantee fee. I have given a guarantee as an Indian parent, but I have not charged any guarantee from the subsidiary of the abroad. So in these kind of situations, there are n number of circumstances which I have seen where the AS 18 perspective or the related party schedule perspective do not disclose these guarantees or the financing documentation that are being given to the bankers. Any aspect where the guarantees are being given, and even if it is part of the contingent liabilities or any other notes to accounts, have to be identified and it has to be reported. If the guarantee fee is not being charged, it is very, very important that you do a minimum element of 0.5 or 1% on the overall corporate guarantee, which is on par with any other financial institution to do it. So purchase and sale of securities in terms of the valuation are the key elements. There is a departmental, on the floor kind of a circular which is given, which is field instruction given to the authorities saying that don't get into valuation related kind of queries if it is not impacting the P&L. If it is only an issue, if it is only a specific aspect of share capital without the premium or the book values, do not get into the specifics of the valuation. Any circumstance where the valuation is pertaining to a premium or affecting the P&L and having projected numbers versus actual numbers kind of situations, there is a dispute that still exists. But it is very, very important that how you structure the timing of this valuation and where it is exactly being placed and the backup workings for the specific projections and the actuals, because 3 years down the line, this will get picked up for the assessment and this might be asked as a comparison to the projections versus actuals. So we have to be very, very careful relating to that particular aspect of valuation for a share transfer or issue or a buyback. Now, mutual agreement or dependencies, these are cost contributions, cost sharing or joint arrangements where the shared services or facilities or benefits are enjoyed by both the parties, the common cost attributions, how they share the mutual benefit aspects and the cost element relating to that, and what kind of markup, if at all, I am providing services to the parent entity or I am receiving services from the parent entity abroad, what are the specific items of the cost and centralization of such kind of mutual agreement kind of arrangements as a policy are very, very important. Now, there are two other international transaction clauses, and then we move to the SDT. Now, business restructuring aspect, again, is the most ignored part or ignored disclosure part of the Form 3CB, I would say. Mostly everybody goes into the web of mergers, demergers, acquisition, but any transaction which has an impact on the supply chain, that is, I'm providing the same set of service today at 10%, and I'm a particular service at 10%, say suppose an offshoring or a business support service, and I'm also performing the same service next year, but I've increased my profitability to 15%. So you need to have a specific backup or specific reasoning with a solid proof that why this increase from 10 to 15 if you're providing the same set of service, and why not 15% should be applied to the previous year transactions. And if there is a dip in the profit or increase in the profit, change in the characterization, additions and deletions in the scope of activity or specifics of supply, the business restructuring or reorganization in the supply chain elements are very, very important for us to understand, and this is required to be disclosed. These are one of the important and toughest transactions to be valued or to be recorded and compared as an arm's length, I would say. But the identification, documentation, functional analysis, and specific economics with which you kind of disclose this real value or value add is the key element for this disclosures. So other than mergers and acquisitions and cross-border restructurings, the specific aspects of supply chain and any kind of term movements or profit movements are to be very, very closely watched or required to be closely watched. Now, the residuary transactions, the last clause of the international transaction, these have specifics of reimbursements, outstanding receivables, and any kind of dependencies on server is being provided with free of cost, or any kind of ESOP related transactions are happening and it's not required to be reported under share issue, or the cost elements are being given as freebies and other aspects of residuary clauses which are not covered specifically in any other clause above are required to be disclosed here. Now, coming to the specified domestic transactions, the deemed international transactions are specifics where, sorry, so I think deemed international transactions we will cover and then move to the SDTs. Wherever there is a prior agreement and there is a profitability and the profit influence is there because of the prior agreement between domestic third party also, and the third party has already entered into an agreement with my parent entity as of the supplier, then the transaction is controlled, and this particular pricing influence and a prior agreement are the two important checkpoints for you to see. And in most of the situations, nobody would come and say that my global agreement is there and that is why the supply is happening here and the price is influenced and I'm doing this. But you need to understand from the websites and the public domain information that both these entities are working together globally. And it is very important that we highlight this kind of risk to the assessees and also for the clients, and say that, there is a specific clause. And if you're not disclosing this under this clause, you might end up saying it is underreported or misreported or non-reporting kind of a scenarios also. Most of the Chinese entities and Korean entities are falling into this web that, they want to break the chain by cutting down the related party, relationship by posing a third party in between. But by looking at the global scenarios and also from public domain information and kind of pricing at which the transaction happens, we can easily stipulate or tell that it is a deemed international transaction. So there has to be a prior agreement, there has to be an influence in the pricing, and the transaction is between domestic third party and the third party has a global agreement are the supply chain attributes and requirements for the deemed international transaction. Now, SDTs, yes, one entity requires to be eligible. What do you mean by eligible? Either 80IA deduction or a 10AA deduction has to be there. These are the prima facie tax exemption scenarios or tax exemption sections that we have. So the objective is to check extraordinary profit not being parked in these kind of tax exempt units or undertakings. Now, any good or service that gets transferred between eligible businesses and non-eligible businesses, the key checkpoint is either or of the entities should be eligible, and the value, nature, description, quantification as per books, as per arm's length, the method and the remarks are all the same. But do you feel that there is any kind of extraordinary profit will be the question. You will see that when the slide comes. But any transfer or acquisition of good or service. So they've covered all the specific aspects of quadrangular situations. But if you get into 23, there is a specific requirement where you say that business transacted resulting more than ordinary profits. This is a very dangerous clause, but if you disclose it here, you need to also have the basis that this extraordinary profit is not resulting from an arrangement from any of the related party transactions. Sales are there to a third party, and there is an inter-unit supply that is happening at cost plus 10. So the actual transaction between inter-unit entities is only a cost plus 10%. So your 10% criteria, if you are able to justify that it is at arm's length between two eligible and non-eligible units of a particular entity, then whatever you are selling to the third party as an export and you're getting an extraordinary profit out of it can be defended. So this is a very important thin line of difference that you require to disclose and at the same time have the backup for the justification. Transactions, 115 BAB and BAE. BAB is the manufacturing, BAE is the cooperative societies with the same kind of facilities, 15%, 17.16% are the tax rates with surcharge and cess. And if these entities are dealing with any kind of 25% or 30% entities, then the transactions have to be disclosed with kind of saying that your transaction is at arm's length and there is no shift of profit between both the entities. Always go for the relevant forms, look at the unit profits, have the specific comparison in terms of what they are doing and what the tax paying entities are doing. Is there any shift of business from the tax paying units to the low tax units, and it is being done willfully or not, are the checkpoints. So as an assessing authority tomorrow, the tax authorities will definitely check whether the pricing is influenced and there is an arrangement to move the profits. So these checkpoints are very, very important for 80IA, 10A, and 115 BAB and BAE sections. Last clause is this residuary clause, where there are specific aspects of cost sharing elements between intercompany or inter-unit transactions, and there is a common cost element, and there are any kind of reimbursements or specific mutual agreements or management fee kind of situations where common cost attributes get attributed between both the entities. So the clauses are done from an overview perspective, and I'll quickly run through the slides where the challenges for each and every clause are going to come, and I'll hand it over to you, Rishabh, in another 10 minutes or 15 minutes max. So if you see the transaction flow or the specific items of the transactions in each and every clause now, tangible, goods might be raw materials, finished goods, and capital assets. These are the category of the transactions. So there is three different clauses: manufacturing or trading. And the methods that you can use depends upon the business model and also from specific aspects of what exactly you're doing with the related party and at what pricing and what characteristics and what risks you're adopting. So you have to give a method for each and every line item which is getting disclosed. You have to also judge on a true and correct view. That is not a fair view, not true and correct, not a true and fair, but a true and correct view, saying that the transactions are checked, the method is applied, and I have seen the PP documentation and I have the arm's length nature in comparison to the books of accounts. So CUP is used for a trading or a manufacturing or a supply kind of arrangements where you have an open market comparable or an independent transaction is a strict aspect. CPM is any kind of contract manufacturing kind of setups. TNMM is a general global residuary method that anybody would use to test the net profit and the offerings to the tax. RPM is basically used for trading kind of entities. So methods depend upon the supply chain, business attributes, the key terms, and what are elements of characteristics and risks that you're adopting in the course of the transactions is the key important aspect. So for capital goods, generally it is the valuation report or the fair market value or independent quotations. So that is the reason mostly it goes under other method. So these are revenue attributes or P&L attributes, and this is like a balance sheet element. So valuation and the value, the fair market value at which the transaction generally gets traded as a quotation also can be taken to justify that under other method. Now, most important things are whenever you talk about tangible, the gross profit calculations in terms of the elements which belong to the raw materials and trading aspects and the direct cost elements, all these aspects which are forming part or other than the purchase value of the real unit, like cost, insurance, freight, or free on board kind of situations have to be compared. Are they being paid to the related party inclusive of the price or exclusive of the price? And are there any discounts, gross versus net? And are there any elements of valuation that are being done from two custom sports perspectives? Any kind of cess, any kind of regulations that are coming into picture because of which the value has been very high, but actual value at which the transaction has been traded is different, but landing price might be different. So there might be X number of taxes and freight and insurance and surcharges and cess and all those elements. So you need to see the actual value that is going into the related party for comparison. In terms of mostly from CUP perspective, back-to-back arrangements. For assets perspective, fixed assets movement schedule, the invoices, physical tests, the plant and machinery valuers or any kind of land and building valuers, the valuation reports, and the lens is obviously there with on the work of the other professional. But mostly in terms of the fixed assets criteria, the transfer of a fixed asset from one jurisdiction to the other doesn't happen, but it is mostly an intangible situation that might generally be more recurring in nature. Now, coming to the intangible property, there are three different aspects: transfer, licensing, and developing. Wherever there is a development, you need to get remunerated for your cost and cost plus. Wherever there is a licensing, there is a right to use for which you are paying and what what benefit and what kind of costing is there and a markup that is being applied, and are the developmental efforts being remunerated? Is the real value being given to the actual hardworking supply chain entity? Are the key important aspects that you need to do as a test basis. The fees will be on the basis of the value add, and the specific supply chain attributes, contributions, and if the exploitation is happening other than for the hardworking entities or the developing entities or the contributing entities, then there is a mismatch in the entire DEMPE analysis as such. So whoever works will get more revenue, and he has to be attributed that value with a specific formula and a logical sense, with a real value being shown as per the contributions. So wherever there is a transfer, yes, valuations for intangible properties is the most toughest thing. And somebody can say, 1,000 rupees, somebody can say 1,000 crores also. But from a IP valuation standpoint or ownership standpoint, do not go by the regular valuation report. There are specific intangible valuers that are there. We've specialized in the intangible values, and I've seen certain hard to value intangible assessments also happening in India. And there are very, very crucial elements that are being missed while reporting the Form 3CB. In terms of an intangible property, do you see manpower as an intangible property being transferred from one entity plucked to the other entity? Do you see a transfer of the entire supply chain being plucked from an eligible business to an ineligible business? Do you see the ownership management of the intangible suddenly getting shifted from one place to the other, and the licensing rights are being given to the owner suddenly? So CWIP to a licensing part, the transition that happens and the value at which it happens. So I just transfer the CWIP at a book value, but my parent entity transfers it to any other third party at a 10x or 15x value immediately within the same year or immediately within months of difference, then that can be questioned as a valuation per se. So you need to be very, very careful for all the three aspects: development, licensing, and transfer. So the first, 6 or 7 elements in the next, 10 minutes will be the same. So I'll not spend much of a time here on the name, address, unique identification, PAN, TIN, or, the name, description and nature. You need to give the description and nature types. And I'll start from here in terms of the analysis or the economic analysis part of you. As per books, what value has been recorded for this related party transaction, and as per the, as computed by the assessee, with the documentation, with a method, what is the arm's length price? The book value versus arm's length price is to be compared in both these sections, and you need to give the specific aspects of the method. What have you used? And any kind of observation, you need to give it at the last column. So intangible property, development, transfer, license, and what specific aspects with whom you have done, what kind of reporting you have given, and the value at which the transfer is happening, and the supply chain attributes of DEMPE are the most important things. So intangible property, in my sense, for pharma companies, service companies, and any kind of digital companies going forward, these are going to be one of the toughest, assessment years that I would say, in terms of the evolution with which the department is thinking about this particular intangible property kind of, transactions. So mostly, I think, I've covered all this, but on AMP part, I'll just spend time here. Whenever a global brand is being promoted by incurring advertisement, marketing, and promotion expenses, the specific aspects on the disclosure, whether you yourself report it as a separate international transaction, or you say that it is part of the shareholder activity, or it's part of my supply chain, and I've offered decent profits in India as part of my P&L, and I'm not incurring those expenses for the related party, I'm incurring the expenses for myself as a commercial expediency, are the important confusions that come into picture. So AMP, from North standpoint, or a major distributor of electronics companies, almost all the entities have been covered. And this started with a Vivo kind of situation, and then it went on to all the electronic companies. And distribution of a foreign brand, incurring expenditure to make that foreign brand visible and recognized, and your effort in promoting a foreign brand are the key checkpoints that the officers are applying. And they treat this as a separate international transaction because it can affect your P&L. So AMP by turnovers, AMP by operating costs are being checked as a litmus test, and the bright line aspect is compared with the percentage that you are incurring at your P&L versus the percentage that you are getting as an average in the market for similar industry. So if there is any excess, then you have to do the disallowance, or do that arm's length adjustment. And if there is no, if you are within the arm's range of the market, then you are not required to do, and you can call it as an arm's length transaction. Mostly in each and every aspect that I've covered now, these 7 points would be the same in terms of the basic facts. And I would start with only specific sets and the characterization or the limitations right now. Services, characterization, nomenclature, agreement, and substance, and the specific aspects of the cost, people who are there behind the service, what kind of nomenclature and contribution in the supply chain is being happening. So there is only a distribution and a front ending that is happening at US level. And if the entire development and the brainchilds or the intangibles developers are sitting here, you cannot call them as a cost plus anymore. So you have to give a distribution or a license fee only to the parent entity, which is performing only the front ending aspects or getting the customers. But the development aspect would require more and more markup. So the most litigated, topic is for services, selection of comparables in terms of characterization of the entity, in terms of their profitability, and your entire nomenclature, the qualifications of people who are behind it are the key attributes to prove whether it is a low value or a high value kind of a criteria, which would immediately impact the profit disclosure of such transactions. Benchmarking, you should always check for internal comparable, whether there is a specific third-party transaction that is happening. How can I check for internal comparable, sir? You have to see the P&L in terms of sales purchases of the P&L numbers versus the RPT numbers that are there. If there are specific differences that are there in sales and purchases of the related party, they are dealing with the third-party transactions, and there is an internal TNMM or an internal cup that might be available. So you have to be very, very clear and specific on the questions also. I'll cover the checklist at the end. Now, after the characterization of the service as a limitation, the method used and the data that is being used for the loan transaction is what we wanted to cover here. Any kind of loan that, travels between two borders, that is from a lender and a borrower jurisdiction, what is the cost for the lender, and whether it is already a cost is being incurred at the lender jurisdiction, and whether he has transferred the amount at a foreign currency or an Indian currency, INR, are the first checkpoints. So the loan terms, agreement, currency, reporting period, and the credit rating of the borrower are the important checkpoints with which your benchmarking of the loan has to start. So the documentation, and if there is a global policy as a a common lending point that gets transferred for all the loans, you need to be very, very specific that this is a policy that I follow, this is the cost that I have, and this is the spread that I'm going to charge for all the entities. So you have to have both sides into perspective, and you cannot do a loan benchmarking from a single perspective always, because both the sides might ask for the specifics on the other side in terms of your reporting transaction, and also from the lender's perspective jurisdiction. What exactly are your costing elements? Are you having free reserves, or are you having any kind of loan at that particular jurisdiction? Also are the key checkpoints. Mostly, tax authorities have been using the general PLR, LIBOR, or US Fed rates. And I was disappointed even with the special bench ruling of, LIBOR plus 200 being applied for debentures or stuff like that. But the point is, if it is the INR denominated, transaction, if it is a foreign denominated transaction, the source jurisdiction and the currency with which the flow of money is happening is very, very important. You cannot apply zigzag like INR denominated as compared with US LIBOR and have the US sourced entity with PLR comparison and all. So source, currency, and the duration and the specific aspects of credit rating are the key important aspects. Don't go with a common interest rate generalization aspect, which the tax department is currently doing. Now, I've covered everything, but in terms of this loan transaction, there is also a specific, thin capitalization rule that is being applied, and there are specific, checkpoints that you need to do for a loss-making entity, and overall on an EBITDA level, the percentage should not be crossing. So you need to have whether there is a moratorium period, whether there is a specific aspect of no agreement being there or no terms being there. But at a year-end adjustment, if you are doing any interest, inclusion into the schedule and saying that it is at arm's length, you need to be very, very vigilant about the entire interest flow or each and every accrual level. So whether it is inclusive or exclusive, compounding, and whether you are having any third party elements and you do similar kind of advances or comparability transactions in terms of credit spread or credit periods, you need to be very, very specific in the documentation. You need to have all this established. So moratorium periods, yes, FEMA might allow you to do a moratorium period, and you may not be able to pay, you need not be required to pay for such kind of 3 years or a 5 years period in the beginning. But any kind of accrual that is happening in the books of accounts, or you're not accruing it because I'm already approved by FEMA, but from a transaction specific perspective, if you're looking at it from two jurisdictions, whether to benchmark it or not, yes, the benchmarking has to be done, and both jurisdictions have to approve this to be at arm's length if you're doing the reporting and TP documentation from both the jurisdiction standpoint. So important aspects of the loan benchmarking, challenges, where there is a loophole, how it is being looked, how the department looks at it, and what kind of moratorium periods or loss-making entities or EBITDA percentages on thin capitalization are the important checkpoints that you need to remember whenever you are doing the loan transaction. So guarantee, implicit or explicit, whether you charge a guarantee fee or not, you have to disclose the guarantee transactions. If it is part of AS 18 or not, if it is part of contingent liability, guarantee has to be disclosed. Even if you're not charging the guarantee fee, please apply arm's length nature of 0.5 to 1% as a bare minimum, and go ahead and show the finance companies or the banking elements where the 0.5 to 1% charges are applied at the public domain. It's easily available. So the arm's length pricing has to be applied, and there has to be a disclosure. You cannot say it's zero and it's a shareholder activity anymore. There were arguments that guarantee cannot be treated as a separate international transaction, and I'm not a financing entity, and it's part of the shareholder activity at all. But after 2012 and the amendment that has come in, mostly all the transactions wherever there are specifically asked in Form 3CV, there has been no mercy by the department. They want the disclosure and they want the arm's length testing to be done, and the basis for the arm's length defense and the justification are also being asked very, very clearly. So mostly from other aspects standpoint, whether marketable securities, transfer, valuation, equity buyouts, buybacks, and debenture or preference, all the aspects of the share related transactions are required to be disclosed in clause number 16. Valuation is important, projections are important, any specific aspects on the terms and unique nature of the transactions or the capabilities for conversion and element of profit jump in a specific year as compared to the projections can also be asked by the authority at any given point of time during assessments. So you compute, is the requirement to compute ALP done away, since there is no requirement to report ALP in clause 16. So you need to identify this particular difference here. So method used, consideration. So arm's length specific has not been asked here because it is mostly transaction relating to purchase and sale, and transfer should be at arm's length. So mostly we write the arm's length nature or the specific aspects of valuation here in the observations. But you need to understand that there's no requirement to report ALP in this clause 16, and specifically from relating to valuation perspective, other method is used, and preference shares to equity conversion related aspects and buyback aspects are also required to be disclosed here. So there is a field instruction not to touch the share issue at a book value or initial transactions. Transfer, definitely yes. There was a huge dispute around Vodafone area or the period of Vodafone judgment, where the transactions on profit element not being there but still being questioned as a share premium by the authority are being held in favor of the assessee, and immediately they came up with a field instruction saying that if it is only a share issue, do not ask specific questions. If it is valued and valuation report is available, then don't dispute from a transfer pricing perspective is concerned. Definitely recharacterization and 1:7 ratio in debt and equity perspectives and the valuations around it, and specific elements of the transaction impacting P&L, not impacting P&L, deemed loan, share application money not being allotted. There are specific aspects which are hidden inside this clause, but you need to report each and everything. Always do over reporting, but never under report anything. Why? Because any kind of under reporting or non reporting will lead to your risk parameter, and you might be picked up for a full-fledged scrutiny on transfer pricing. And the mutual agreement or arrangement, this is not clearly defined, and there is only a dependency aspect or the mutual consent between both the parties is that I would say, and any kind of benefit sharing or facility sharing that happens between two related parties that I would say. So you have the same set of questions again, but as per books, as per arm's length method and reasoning or any kind of observation that you can give. Mostly all these aspects are from common cost point of view, allocation key point of view, challenges in identifying these kind of transactions not being charged back by each other. There is also a tangible benefit that you are receiving, and the quantification and justification of it from a cost allocation standpoint on what basis is required to be done is a key important aspect here. Mostly cost or audit reports and cost allocation criteria of turnover, sales, or employee headcount, or space, or number of machine runs are the key allocation keys that are required to be taken into consideration for the cost-based allocation, and the markup depends upon the valuation or the value add that you give as a top up to the entire supply chain. So the cost base will depend upon the cost allocation criteria, and the markup will depend upon the nature of service that you are actually giving to the mutual benefit or a facility that you are giving as a mutual benefit to the other side. Now, business restructuring transactions, supply chain changes are to be considered, merger acquisition, and there is a specific, differential point that is there in this clause, that is the agreement in relation to the business restructuring or reorganization. If there is no agreement, and if suddenly an addendum is done at the year end, and there is already change in the supply chain that is already being implemented, once you rose this topic that this falls under a business restructuring, they've given you a backdated agreement. In that kind of situation, whether you will call it as a arm's length or not, and if there is only a single year-end adjustment or a true-up that happens after you post the transaction, or after you post this requirement of a business restructuring disclosure and arm's length, if they are doing it in the books, then there is no problem. It's at arm's length. But if they are not doing it in the books, and if you are doing it here in terms of disclosure separately over and above, and you are asking them to fill in any kind of additional profit or a voluntary DP adjustment, then this disclosure and that valuation of the business restructuring profit element is very, very critical. It gets too complicated, but you need to understand supply chain and any changes in the profits, any changes in the contributions, any changes in the mergers, acquisitions, cross borders of the shared pattern or the business restructuring arrangements that are done cross border are to be closely watched and valued. So mostly in terms of your clauses on the international transactions, mostly I think would have covered the specifics, but on any transaction having a bearing on income, profit or losses or assets is very important. You have to understand that these transactions mostly, when it is calling that there is a bearing on the profit, income, losses or asset, but not specifically referred to the associated enterprise above. So this is the residuary category, and any transaction which is having a bearing on any of these four elements, you have to disclose it here and make sure that the disclosure is complete. So you have to note down wherever the transactions have not been identified, not been recorded, not been reported in the RPT schedule or in the books, and make sure that all these disclosures are happening at the residuary clause per se. So deemed international transactions will come to that, and the key important checkpoint that I would say to remember is whether the tax-paying entity and eligible entity, and tax-paying entity is dealing with any kind of eligible entity, and the reporting should happen on both the sides, and they have to price their terms and conditions and the inter-unit transfers at a arm's length situation. There should not be an arrangement between the tax-paying entity and the tax quality entity that results in extraordinary profits are the key important points. So the third party here in any of the situations, the deemed international transactions is what we'll cover here, and then we'll go to the SDT. I moved to SBT, I think. Sorry for that. So deemed international transactions are covered where the third party transactions are being done and you have a prior agreement and there is an impact on the profit. All the aspects of the covered transactions in terms of international and the specific residuary clauses are also covered, where the influence is there and the third party has already fixed the price and the transaction is happening only to break the related party transaction direct correlation. So you need to understand that, there is an influence of the parent entity everywhere, and this is a global agreement that is happening. And is there any influence on the profits? Is there any influence on the reporting per se? In terms of the covered attributes is what you need to check for these deemed international transaction reporting. So I would go to these. This is what I was trying to tell on the domestic transactions. 10C-CB and 56F have to be taken into consideration. You need to see the profit, you need to see the turnover, and check the profitability first. And the other aspect is, whenever you are doing a transaction between eligible entity and a tax-paying entity, the transfer is happening at what value, and is there any close connection? So these important words are to be taken into consideration. Close connection, more than ordinary profits, through these arranged transactions is what you need to understand. So you will first define what is the nature of business, all these specific elements of the tax holidays that are available in any of these services or provisions, and what is the triggering condition that will report or make it report in the criteria of SDT are the most important criteria. So wherever there is a close connection, wherever there is an arranged transaction, wherever there is more than ordinary profit, wherever eligible and non-eligible units are trading with each other, you will have all the attributes coming into picture. So you need to remember 10A8, ATI10, and specifics of power, SEZ, and infrastructure telecommunication as keywords. Mostly profitability is a checkpoint, and then they go back to the specific transaction values. What is intra-group and intergroup transaction? What is the description of good or service as per books, as per arm's length? Profitability is in reverse, because you are a reporting entity or an eligible entity under tax holiday. Your profit should be on par or less than the arm's length. If you are having a tax paying status and you are dealing with a related party, your transaction profitability should be more than the arm's length of the market. So you should be very careful in deciding the conclusions for an eligible entity and for a tax paying entity as such. So the combinations you see here, eligible business and non-eligible business, yes, SDT comes into the picture. Eligible, non-eligible business and tax paying units here in the example, not applicable. But eligible and tax paying, again, yes, you are applicable for reporting. So the combination should be one tax paying and one tax holiday always, and the reporting should be aggregate value of more than 20 crores. So 115 BAB and BAE4 are the differentials of 15, 17, and 25% transactions that are reported. Entire base and the objective and the reporting, the elements of reporting are the same. And the residuary category of reimbursements or cost contributions or any kind of mutual arrangements between the intergroup and intergroup transactions are the residuary and the last checkpoints. I'll quickly finish in another 2 minutes, Rishabh. The backdated filing or eligibility to file these, from 3CEBs are required from all these, years. You can still do the filing. This is a screenshot from the portal. So from 14, 15 onwards, even if any block happens or any kind of, backward filing has to happen, the portal is still allowing you to do. And we've done few filings during the course of assessments, after the pickup, and during the course of challenge on the specific non-reporting of a specific transaction as well. Now, the key important points, everywhere you need to check the value versus market, reporting of the books versus arm's length. If there is a cup, whether it is internal, external, or a serious, full-fledged, strict comparable or not. When there is an availment of service, you should always go for the cost base, the value, supply chain, and the category of the entire value addition that you are providing. Then you can decide the markup with the comparison with the arm's length fair market value. Royalty or know-how, other than the withholding aspect, mostly it is about the benefit test. You need to check whether you are getting that benefit while paying any kind of royalty, license fee, or management fee. Intangible property transfer, value add, and the developer getting the real value or the percentage of the profit being given to the developer or not, and making sure that the jurisdiction which works for the intangible is getting enough profitability at the end of the period of the development or at the commercialization period. Cost sharing is always a reporting and a high litigated topic. Cost plus markup, the spread and the arm's length nature and expected benefit out of this cost sharing is always the key 4-5 are always the 4-5 questions that are being asked by the tax authorities. So you need to keep all this in mind when you are actually reporting a transaction. It's just not reporting as per the AS 18 and writing it as cup and say arm's length and get done with it. So for each and every type of transaction, what is the background and what kind of pain points can be asked tomorrow by the tax authorities? What exactly are the challenges that you will be facing? If you know this entire background, then you will really enjoy the transfer pricing real value and in the certification of this Form 3CB as such. Credit period for receivables and payables is checkpoint, guarantee, implicit, explicit, performance, financial, all the guarantees have to be reported. No shareholder stuff. If you want to report as a shareholder stuff also, you can say 0 and 0 and say, I'm not going to disclose any kind of guarantee, but 90% of the situations, if you're saying 0 as per arm's length and shareholder activity being disclosed, you are being picked up for the transfer pricing assessment. Specified domestic transactions, 20 crores, eligible, non-eligible. Wherever there is lending and borrowing, always go for this ThinCap 94B and check whether your EBITDA percentage is being taken as a checkpoint or not. The last slide for me, and in terms of the risk assessment criteria, what happens when I don't report the Form 3CB? The most important question that anybody would come to me generally is the fact that I won't even report. If I report, then there is a problem of risk assessment or TP assessment being come up and say that there is a large value of international or domestic transactions in your P&L. So it might be picked up as a red flag and put it into the TP assessment criteria. If you don't report it, 2% is the international transaction value as a penalty and 1 lakh as a penalty. So people keep taking the chances. But if the reporting is not happening, then you go under misreporting or underreporting, and the penalties can be very high. And the compliance aspect is taken as the first criteria. Thus, if he fails to furnish any Form 3CB or despite having the international transactions, this is one of the key criteria. And there is a backend program going on which would compare the financials or the related party disclosures under the Companies Act versus the Form 3CB as well. And they would check this as a parameter wherever and pick up immediately from CAS scrutiny parameters itself. So the risk criteria would start from the reporting. So always report and then do the rest of the checkpoints that I've been discussing. If there is a prior adjustment of more than 10 crores in the previous year and you are in an appeal, it gets automatically picked up. And if there's a recurrence of the transaction, the same can keep repeating as an adjustment for you. So you need to be very careful for the first year TP adjustment and make sure that it is getting killed in the second year conclusion itself, before the second year conclusion itself. Any such survey investigation and the block assessments, and if it is a reference for the international transactions as such, the TP assessment proceedings will happen not as a block, but for each and every individual year. And all these years, results of the arm's length are being incorporated in the block period orders that are being passed. So you need to understand transactions and individual benchmarking in the specific aspects of the arm's length determination are to be done. And the reference, satisfaction, the economic analysis, the independent, arm's length determination has to be done by the AO. Has to be done by the TPO once on reference by the AO to the TPO. And if any risk parameter on related party or group transaction or SDT comes into picture, TPO AO has to send it to the TPO for TP assessment as a separate wing. As of now, all the TP assessments are happening as a physical. Now, division of responsibilities, you should always understand that the database of all the referrals and outcomes is being tracked. And only refer if the AO refers only international transactions, can the TPO do SDT assessments also? Or he is referring only one transaction where he is not reported? Can I assess the entire gamut of international transactions that are there in the P&L right now? Yes, they can expand it to the entire transaction. They can also go into the other aspect of international and domestic. But generally, they are covering only the specific set of international transactions or domestic transactions as an entire gamut. They are not, doing both, but they will see the whole gamut. If it is referred for one transaction, also they will see the whole gamut of the related party transactions. So I'll take a small pause here and hand it over to Rishabh for TP documentation, master file, and CBCR, and then maybe if the time permits, we'll do some case studies as well. Rishabh, sorry, yeah, please go ahead.
Thank you, Mithilesh, for wonderfully covering each and every clause. and also covering the checkpoints, pitfalls, and finally summarizing it all. So I've checked the question board also. There are less number of questions. So I will take some time on the TP documentation and master file and CBCR before we actually go to the questions of the participant. And until then, the participants can also take this liberty to put some questions in the Q&A section. So what you see on screen, I have displayed a very concise version on the right of the contents of the local file or the transfer pricing study or the TP documentation, as a lot of people call it, and which has a threshold of 1 crore of international transaction. So if you cross that threshold, you need to prepare that document. There's a format. There are contents that have been specified uh, to maintain the TP documentation. Right. What usually happens and what we have seen as part of the experience is that the contents itself are not complete. If the contents are complete, but certain times they are not relevant. So the idea over here is to give a very brief of importance of each of the sections that you see and what exactly is included over there. Right. When we talk about so going from the top, talk about the about the entity, the structure, the industry it operates within. So these might seem very trivial in terms of depiction that okay, I can tell about my group, I can tell about which industry we belong to. But the idea over here is to try and categorize the company or the group itself based on the industry overview or industry overview you are giving. So let's say if you are into software development and if you are giving an industry overview of other IT services or a BPO for that matter, so that is a misclassification, and our own analysis is starting with a contradiction that where am I classifying myself as part of the industry overall, right? So these two sections set the base and are one of the most important aspects of any of the transfer pricing documentations. Uh, so only checkpoint over here is that we should be very careful in while drafting the industry overview itself, having those sources on hand and taking the industry overview from credible sources. So that's the idea and importance of these first two sections. Then we also present the functional analysis or the analysis for FAR, for functions, assets, and risks. Uh, I don't think I need to tell the importance of doing a FAR, but in a very brief, uh, so FAR helps you characterize the entity. So what sort of a service provider, what sort of a manufacturer, what sort of a trader the Indian entity and the associated enterprises are. Basis for you may get guidance on selection of which method has to be used. Basis for you may get guidance on the comparability. You may get guidance on selecting the proper profit level indicator. So all in all, to say the FAR becomes the heart and core of your complete analysis that goes forward. The way you benchmark, which method you use, what comparables you pick up, which entity is what, so who is shown from the FAR or the functional analysis. So once that is done, we continue to document on which entity we are going to test. So the selection of tested party, I would say there is no barrier on having the non-resident as a tested party, but of course there are certain jurisprudence which have rejected on certain criteria that you should not select a foreign tested party. But in an Indian context, uh, there can be a foreign tested party as well. Then, of course, going on to selection of your method, that has to be clearly depicted that we have tested all the methods, all the 5 methods and the other method as well, because there is no hierarchy onto the methods. We have tested those methods. Based on those testing, we are selecting the most appropriate one and also negating the other ones with proper reasoning on why we are not selecting a particular method, be it on the nature of transaction, be it based the data availability, be it based the comparability itself. So the reason should be very clear in terms of what method we are selecting as the most appropriate and also the methods which we are rejecting. Based on the selection of method, then we go on to show how we have benchmarked. So if we are doing a net level analysis, so we tell about the database to the selections of comparables show the complete search strategy, and finally the results. If you are going for a gross level analysis or if you're going for a cup analysis, you need to draw on a comparative table, be it internal cup or an external cup, draw a comparative table, enumerate the terms of the agreement, enumerated the key price terms or discount terms or whatsoever commercial terms, show the comparison on a peer-to-peer basis between the transaction with third parties and related parties. That's how the economic analysis of using cup method would look like. And finally, concluding with the tested party margin calculation, or if at all using cup analysis, then the key terms that whether the transaction that has been entered by the SSC is at arm's length or not. None of your TP documentation is complete without having a proper conclusion on the arm's length testing. The complete process of testing has to be enumerated above before we conclude. And of course, executive summary will show all of this analysis when we are, presenting it to the management. One important thing that I would like to highlight here is the chronological order of the things that are done. Right. So the management prepares books, accounts are there. Then normal stat audit is done. Books are accounts are finalized. Stat audit is done. Then we prepare the transfer pricing study as well. That is the compliance documentation. After preparation of the transfer pricing study is what the Form 3CB is signed, right? Because transfer pricing study is the main document which is depicting and expounding on whether we have transacted at arm's length or not, and if yes, then using which method. It is shown in the transfer pricing study. Basis that the Form 3CB is filled, and as chartered accountants, we are certifying or signing the Form 3CB for our client, right? So this is one important aspect that we need to know, that chronologically TP study should come before. Forget about what happens practically, but ideally speaking, there should be a TP study basis which we are preparing the Form 3CB, right? So we have depicted the detailed contents here, but since of the paucity of time, I will go on to show a similar summary for master file as well, right? So master file itself is not a transactional level reporting like we have done for in the TP documentation or the local file. It's more of a group level reporting. It's a high level or 30,000 feet view that we are trying to present here of the whole group. So things like group structures, what each entity is characterized at, or what is the description of each entity in the group. If we have any intangibles, supply chain, things like which are my top 5 products, which are my top 5 services. If at all I have any group financial arrangements, or if I have any cash pooling arrangements, if I have any shared service arrangements. So all of these things need to be reported as part of the master file, right? The idea to take a master file is to have visibility on the whole group, and it is being filed with a very high threshold in India. Only thing is that Part A is one pager form is available to do that. But ideally speaking, master file would be for all the group entities operating in a particular jurisdiction, and gives a bird's eye view of what is happening across the group and how the group is structured in terms of different transactions that happen, right? Something similar but yet different we have as part of country by country reporting. So when we talk about country by country reporting, we saw in the initial slides that if one of my group entities or my parent entities is doing a country by country reporting in its jurisdiction, and India has automatic exchange of information with that jurisdiction, you may just file a CBCR notification in India so that the tax authorities can take the CBCR information from the relevant tax authorities where the parent entity has filed the CBCR. Right. CBCR again is a group level reporting. However, there are financial data points that are there in the CBCR itself. But since it's a prescribed format, it's easier to do exchange of information. Right. The prescribed format again starts at the group level. What each entity is doing, how many employees each entity has, which jurisdiction each entity belongs to, and finally of course, giving the whole group chart or organization structure alongside categorization of each entity or the functional analysis of each entity, which I have depicted here as main business activities, but to show whether entity is a manufacturer in the group, what node or what role it plays as part of the whole group. It is a manufacturer, shared service center, cash pooling, treasury, or it's a low risk distributor, or it's a full-fledged distributor. All of these things need to be shown as part of the country by country reporting. But once it has been done by the parent entity, there is a possibility to not duplicate the effort. I have put some screenshots over here of the three tables, but we have already talked about the contents of all the three tables. I think this actually concludes the time as well, and also our deliberation. We had certain litigation issues, but I would prefer to take the participants' questions before or afterwards. We cannot take itself, but actually, I would prefer to take participants' questions rather than talking about litigation issues, because today's theme has been on the compliance framework of the India transfer pricing. So, Mitlesh, are you there? Should I start reading some questions that have been there
Yeah, please,
on
please
3CB?
go ahead. Yeah.
Yeah, I'll show. So, one of the interesting questions has come for corporate guarantee, that how to identify the value of consideration or determine the value of consideration for the guarantees given if there is no formal agreement.
See, as I told you, the implicit and explicit nature of the guarantee, whether it is performance or whether it is a financial based transaction, whether reported, not reported, anywhere in the related party contingent, you have to report it. The valuation or the specific aspects of the benchmarking on the fee component aspect is like, the start of the amendment happened in 2012, where the guarantee word was included in this 92A2, or the specific aspects of international transaction as such, 92P. But the point is, whenever you are giving a guarantee as part of a shareholder, responsibility only as a paper, and actual risk bearing aspect is coming into picture or not, are the true attributes that you have to check. So if that is being borne, then yes, the fee has to be charged. And quantification of the this guarantee has always been a comparison of a public domain financial institutions or bank charges at a specific range, or 0.5%, 1% that I was telling in that particular slide. Mostly it is around 0.5 to 1, but there are certain circumstances where the risk element has been much more higher, and because of the risk element being higher, it went up to 2%, 3% also. So the valuation and quantification and agreement being there, not being there, there is always a set of documents that they sign and give it to the bankers. You have to see what are the terms and conditions under which the loan was provided by the banker basis the guarantee. So that's the key important aspect here.
Perfect. Another question is there. So Indian company, parent entity, has a subsidiary in Jersey. The Jersey entity was liquidated that year, and alongside, the Indian entity has written off the entire equity investments in its book. So which clause exactly in Form 3CEV this transaction of write-off should be reported, write-off of investments?
I think other transactions should be good enough. Yeah. So it's a residuary disclosure.
Perfect. So we have another question again, okay, on reporting. So there's an Indian entity transacting with another sole proprietor in UAE, of course, common owners. That's why the relationship is there. Total turnover, so total international transaction is 70 lakhs. Total turnover is 27 crores. For the year, what TP provisions are applicable, if at all they are?
Only 3CB, I think the value is only 70 lakhs. No TP report or any other will come into picture. So only reporting of the transaction of 70 lakhs with services provision with the related party. That's it.
Perfect.
But policy, benchmarking, and the method aspect of it has to be written. So please take care on the benchmarking aspect of it and arm's length value of the transaction.
Also, the elephant in the room, which you did address, but the same question has come again. Whether the closing balances with associated enterprise need to be shown in Form 3CEB? If yes, then whether payable, receivable, both or only receivable?
See, it's mostly they're interested in receivables and then the credit period, because it is immediately impacting the P&L is what the intention of the tax authorities or transfer pricing authorities is. So give importance to receivables. If you're disclosing payables also, it doesn't matter. But the point that I'm trying to tell you is where exactly are you reporting this? Are you clubbing the arm's length nature along with the principal transaction? Or are you having a specific set of benchmarking with related party and third party, even for the credit period aspect of it? Whether this credit period is influencing the pricing or not also needs to be documented and tested. So we had a unique scenario where 42% entity was there, 42% margin was there for a software company, but their credit period was around 120 days. So as a general scenario, whatever the margins of the entity at the net level are, the transfer pricing authorities give 30 days for a service entity, 60 days for a manufacturing entity as a standard credit period, and they apply. So we thought, 90 days will be added back and the adjustment would come. But we proved that because of this credit period only, I'm getting that 42% and I'm offering more than what is required, even if you do the adjustment for 90 days. And we gave a comparative and we sailed through with a nil order. So you need to understand the attributes of how to defend and how to disclose this closing and opening balances as such. Yeah.
Here's a follow-up question on, so if I disclose the receivable balance and consider it as a purported loan in the next year, so where should be the interest reported? Again in the other, so clause 19, or should it go under the financial transactions clauses where other
Have
interest
you
are reported?
recharacterized it as a loan already in the books?
So it's not written
That is
there,
not
but
there.
yeah, of course, that's the
If
follow-up.
it is not recharacterized or converted into a loan, then disclose it under other only.
Perfect. Okay, so we have another question. So it says for global capability centers providing services to another jurisdiction, is 3CB applicable? So I think
Obviously. So if it is a wholly owned subsidiary having more than 26% ownership management control capital and that relationship is established, then obviously Form 3CB, TP, all these provisions will come into picture. So it is there.
the last question that we have, and also the time is we are short up by 2 minutes. The last question says advance received from customers for sales, whether to show under clause 14 or clause 19. Advance from customers.
19 is the mutual agreement. Or
19 is other terms.
Better disclose it under others. Do not disclose anything principally anywhere in the principal level of transactions. If it is any doubt that we are having, go to the other transactions and disclose.
Because
That's
what will
better.
happen, this advance next year will be shown as revenue as well.
Yes.
So reporting it in any other above clauses will be duplication. So it should be reported as a balance.
In the prime facie, you're saying?
Yeah, in the first year where I have received the advance.
Second year onwards, if it is repetitive as a advance, then you have to show it as a consistency. Whatever is followed is okay, but you have to disclose it.
We are having some questions for SDTs. But SP sir, I think we have short the time. We have only one question on SDT. If you allow me, I can take.
There is no hard line that it should be over.
Perfect.
A couple of minutes here, there is quite.
Sure, sir. So question on SDT is, in case there is a transaction of sale of goods by one Indian entity, that is the manufacturer availing 115 BAB, so 15% tax rate, to another Indian entity, that's a related party, which is at normal rate, which entity needs to file the 3CEB?
So mostly the targeted entity will be the eligible entity. That's the first preference. But if you're dealing with any kind of eligible entity on the other side, the disclosure requirement, if it is there, then yes, you have to disclose if you ask me. But the point that I'm trying to tell you is eligible entities, 100% requirement will be there. For the tax paying entities, you can disclose it under SDT if it is more than 20 crores if you're dealing with the eligible business as such. So 15, 17 versus 25, 30, you have to disclose it on both sides, I would say.
So conservatively on both sides, but at least mandatorily on the eligible business
entities, mandatory. Yes.
Lower tax rate.
Yes.
Right. So I think there's a question on the chronological order of things that happen. So I mentioned that first books are made, books are finalized, audit is done, TP study is prepared, then 3CB is being filed. Because if you read the first part of 3CB, it says based on the information and the accounts that I've checked, it is true and correct that these transactions are on arm's length.
Yeah.
So if without a TP study, I don't think uh, we are in a position to file 3CEB, and also the selection of method is being justified in the TP study itself and not in the 3CEB.
Hmm. See,
So
on the flow of the transaction as well as the important checkpoints, the share capital level or initial infusion level, the related party transaction influence might start. And also on the subscription or the director's appointment level, the transactions might start. So we need to be very careful on the entire supply chain, business model, share capital, and in the line of business with which both of them are interacting with each other. So for each and every aspect, you need to create your checkpoints and analyze the applicability. Reporting, whether it is done or not, is secondary. First, we need to characterize all this type of transactions and the specific aspects, and then get into the books. So first, you analyze and then check with the books, and then go with the terms and conditions and evaluate the arms length. That would be the criteria.
right, I think the confusion was whether 3CEB comes first or TP study.
TB study.
TP study. Yeah, so that is the crux that has been asked by the participant. I think, SP sir, we are done with the questions,
Okay.
and we have cleared the board, which was relevant to today's session.
Thank you. It was very, very enlightening, session. Thanks to both of you, Rishabh and Mithilesh. And the start was really wonderful when Chitlesh ji gave, the opening remarks highlighting very, very important things, that three aspects: identifying transacting entities, the transaction, and the ultimately the determination of the transfer prices are the most important thing. In fact, taking from the last couple of questions and the discussion which you had just now, in the transfer pricing's life cycle can be divided into four stages. The first one is, the planning stage, which is as important as in, and each stage is very, very important in itself. So the planning is the one where the policy is set up, and it is not static, it is dynamic as it progresses. As the business model changes and all those things, it has to, the valuation part has to keep on changing. But the core thing, if there are agreements, the agreement will remain there. The pricing methodology may change. The second one is that once a policy is set, it has to be evaluated and re-evaluated throughout the year. The third one is documentation, and it's rightly put by both of you. The documentation has to be contemporaneous. 3CB at the end of the year. So documentation should identify, the concerned advisor as well as the business should keep on, making note, because there may be differences between, the prices of in the market and the prices which are arrived at between the associated enterprises. But what are the regions? Those should be recorded. And as one example was given, where there was very high profitability or low profitability, and then the credit period was taken as the reason for this variation. So these things must be recorded, because you never know, who will be there at the time of the assessment. The assessment always happens after 3 years. So it has to be recorded, and recorded in full detail. And finally, it has to be justified before the tax authorities. So the test of the pudding is in the eating, as they say. At the end of the day, that is the one which will justify, the entire exercise. So far as the today's session is concerned, it's in Hindi I say it's Gagar mein Sagar, and if I have to say translate into English, there is no corresponding translation except saying that there is depth and in the simplicity. Both of you, in a very simple manner, explained very complex, intricate facts regarding transfer pricing, and there was depth, but there is also the simplicity. So thanks a lot to both of you for giving a really wonderful discussion. This is one where you are looking at the entire transfer pricing in 2 hours, covering from A to Z is wonderful. Only both of you could have done. It's a great achievement by both of you. And I really thank the participants who have heard through, and definitely they may be having questions. If they have questions, they can always write to Citex, and the speakers will try to come back on that. And finally, thanks to the wonderful secretariat of Citex, our Committee on International Taxation, who have ensured that everything goes very smoothly. Thanks to everyone. Have a good night. So, bye-bye.
Thank you, sir.
Thank you, sir.
Thank you.
Thank you, sir. Thank you, sir.
Bye.